Hi everyone, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Portfolio Manager with McNichol and Associates Asset Management. Welcome back. Well, I want to start off with a question actually from one of our viewers on FANG Friday. Andy writes to me and he says, Ross, I'm confused by your definition of the supergrowth price. Netflix lowest value is its supergrowth price, while Alphabet's supergrowth price is its maximum, and it's gone up 5 times. Is the term supergrowth the same for both? And what's wrong with the supergrowth price if it keeps on climbing like Alphabet? So I got thinking about Andy's question a little bit. And first of all, I thought I would like to tell you what the supergrowth price is. And then I'd like to do something a little bit more profound, and that is to say, I'd like to look at a supergrowth price through time. So the first thing is the supergrowth price, which is 3.5 times book value. Well, the reciprocal of 3.5 is 0.289. And for those of you who are not mathematically, but should we say scientifically oriented, that is, of course, Wien's constant. And 2 other breakpoints, which I showed you last week with Valiant, Bosch Pharmaceutical. One was the growth price, that was 2 times book value, and the reciprocal of that is 0.5. Well, that is the value of the first constant of radiation in physics. And the bubble price at 7.4, the reciprocal is 0.135, and that, of course, is the Rydberg constant. So the world of physics impinges, if you like, on the world of the stock market, and it's very useful not to forget that. Anyway, I wanted to talk about how the numbers change over time. Analysts have commonly said that a balance sheet is a snapshot in time. But of course I got thinking, well, what's a movie? Well, a movie is simply a series of snapshots all strung together, so that if you are shown them rapidly in succession, they appear to move. Well, an SVA chart is pretty much the same thing. We look at the earnings forecast a year from now, and we ask the computer to project today's balance sheet, not a year from now, but we want to project today's balance sheet based on the earnings 1 year out. So we can't move all the way to adding in those earnings to the balance sheet and say, well, there's the balance sheet. No, we're just going to move a day at a time. Of course, it's too slow for you to actually see that motion. But when you look, let's say, at the supergrowth price over time, as some of you have done, and you see that it keeps changing every day, well, that's our way of having a sort of a slow motion movie, bringing the balance sheet to life. In other words, we constantly reconstitute the balance sheet and it becomes alive. Now, let me point out one thing, and that is to say that the stock market does exactly the same thing that we do. But the stock market does it notionally, although, frankly, just as accurately. How do we know? Well, because very often any given stock will stop and inflect or hold right on one of the projected lines that we have calculated. That's why SVA is a huge step up in value to the analyst and the investor over technical analysis. Our values, our breakpoints, are not static, but they are dynamic. Let's take a look at Alphabet over time, and here's a 10-year view of Alphabet. Well, look at there's a beautiful view of Alphabet over the past 10 years, and there's the super growth price, Andy, just rising steadily, day by day, week by week, month by month for the past 10 years. And it has been pretty well contained between two other breakpoints, the low super growth price, or 4.5 times book, and the mid growth price, very occasionally, largely doing major market sell-offs at the mid growth price, which is 2.5 times book value. Our friend Netflix here, which you point out, well, its fair market value. Well, let's take a look at its fair market value. I haven't put it in here, but now I'm going to superimpose it on the chart. And look at that. The super growth price is way down. In fact, it's 71, almost 72% lower than the current price. And you can see, if I put up the 10-year chart, that the value of the fair market value of Netflix is just a little bit above its super growth price. So they figure in both of them. However, the difference between the two companies is that Netflix, over the past number of years, has grown at a compound rate of about 23%, and the past year, actually, the balance sheet has grown at about a 31% rate. Whereas over all of that period of time that I showed you for Alphabet, the 10-year growth rate has been about 17%, and the past year has been about 14%. So there's a pretty big difference in the growth rate, and therefore, of course, the valuation between the two in price-to-book terms is quite substantial. However, that fair market value, I keep reminding people, is a magnet price, and it keeps wanting to draw those stock prices down to it, or if a stock is below it, draw it up to it. Anyway, let's take a look at the rest of the FANGs for now. But before we do, I wanted to contrast Netflix with Disney. And here's the past 5 years for Disney. Well, you can see that there's been very little growth in the balance sheet, and but the fair market value has been just hanging right around its super growth price. So the super growth price is one of those very significant valuation levels. Turning to Amazon, I got a question from Mike, and he wants to know what happens if the market goes off into Never Never Land, and he tells me that he bought some Amazon since it's 8% of the QQQ, and if they don't add in Amazon, they're going to run out of ways to pump that index. So let's take a look at Amazon, Mike, and see what kind of advice that we would give to an investor at the present moment. Well, unfortunately, Amazon is right between two breakpoints. The HB3 at about 16 times book value, that's about 2,000, and the HB2 at about 12 times book value, or about 1555, and the company is kind of threading the needle right down between the two. Now, the issue that I would have is that in terms of an entry point, we tend to like to enter with some precision. That is, I would like to see the stock down at, for instance, HB2. Then I would feel comfortable. Or I might sell it at HB3, or if it breaks out, I might even buy it. When a stock is between two breakpoints, it is essentially, it's its price action becomes a random walk. And remember that the 2013 Nobel Prize in Economics, half of it was given for pointing out that the market is a random walk, and the other half was given to Bob Schilling, who pointed out that there are points in the market when actionable events happen. And the question is, which of the two of them was right? Is the market a random walk, or is Bob Schilling right? Well, it turns out that both of them are right. Okay? In between, you cannot really say anything about where a stock price is going to go. It's only when you get to the breakpoints that something happens. And so, Mike, I wish you a very good luck, and I hope that if the market is strong, that Amazon indeed will head up to the 2,000 mark, where we would be likely, by the way, to sell. But in terms of generally buying the company, I have no idea where it's going to go, and indeed the market here is a random walk. Turning to Facebook, well, we've been looking at Facebook straddling its mid-super growth price. That's 5.5 times book value. It had broken down just a very, very few days ago, but it has turned right around and popped above the MSG price once again. I don't know whether it actually is going to do anything one way or another except straddle its MSG price, and that's not all bad, because if I look at the long-term growth of Facebook, it's running about 16.5 times. It's well, it hasn't been going for 10 years, but certainly it's past 5 years. And if you can have a stock that provides you with a return of 16.5% over the next 5 years, and the stock does not materially diverge from its mid-super growth price, well, that probably isn't going to be one of the worst investments that you could ever make. However, the operative word, it has to hold here. NVIDIA, well, look at the fair market value of NVIDIA. It's really, really picked up in the past year. Whereas if I go to the 2-year chart here, you'll see that in the fair market value is actually falling as the superconductor stocks were really in a glut situation. But with the rebound in the bitcoins, then the analysts have become quite bullish on NVIDIA, and the stock has been rising. I don't think that it's going to get through its HB2 price. I would be very, very surprised, given the fact, as you can see here, that the fair market value is about 50% of the current price. Apple, well, going back to our 10-year view of Apple, we see that the fair market value had really bound this stock quite handsomely up until very, very recently. And in a sense, that's kind of peculiar, because Apple had a couple of quite miserable quarters, and we hear that sales in China have really slowed down. However, that hasn't stopped the stock from hitting new highs. Perhaps we're going to get all the way up to the HB2. That would be 12 times its book value. That would be quite a handsome valuation for the company. Hasn't been there for a very, very long time. And finally, here is Microsoft. And look at this company. It kind of wants to do something, doesn't it? But it's been straddling HB1. That's about roughly 10 times its book value. Some of the time under the HB1, some of the time recently over the HB1, but it hasn't been able to get any momentum going for it. Now, if somebody said to me, well, what should I do about Microsoft? I could say to you, listen, maybe you'd like to buy the stock. It has broken out over its HB1 price, and it's actually held for quite a number of days. Maybe if this market is going to develop a head of steam, maybe Microsoft will develop a head of steam too. But always with the warning that the stock is very, very much overvalued, and this company, therefore, is not without its risks. Anyway, that's a quick review of the FANG stocks. I got to say one thing about the stock market, because before I had said to you, look, the market is getting right up to its own fair market value, that is the Standard & Poor's 500, up to 3150, and very, very recently the stock has broken out over that, and in fact it's about 3220 as of today. So the market has broken out over its own fair market value. So the market has broken out over its own fair market value. This is an event which has not happened for at least the past 35 years. Are we surprised? Yes, we are. What does it mean? Well, with 1% interest rates, stock buybacks, and a president and a Federal Reserve Board which seems hell-bent for election, literally speaking, perhaps the market can go on its own cheerful, merry way. I do note, however, that from a long-term perspective, the market is very, very expensive, and if anything negative were to happen, usually this has been the peak, and I'd have to say that's a warning. If the market can stay up here, that's fine. If it goes on a wild tear, wonderful. But remember, if it cuts back through its own fair market value, probably that's a major sell warning. Anyway, just one quick word. There will be no FANG Friday next week. It's going to be, of course, a very truncated week in terms of days in the office anyway, and we are going to take a little time off. But I will see you on the Friday after that. I think that is January the 5th. And anyway, whatever that Friday is, we will see you then. Anyway, I'd like to thank you for tuning in all of these weeks, both the new viewers and the older ones. Without you, this video series would not be possible, and I have to tell you, it's the highlight of my week. I really enjoy doing this. I want to thank those visitors and viewers who commented on the video. Please keep sending those in. And those who like and retweet the video, we are particularly grateful to. Even those who share it by email, with those who are not on Twitter because they think their friends might like it and have as much fun as we do in this program. If you like FANG Fridays and want to get it every Friday, like this video, and subscribe to our channel. And if you want to learn more about these proprietary charts that we create in-house and how they can help a do-it-yourselfer like you, then either go to strategicanalysis.ca or frankly, give me a telephone call. I'd be happy to talk to you. Better yet, if you live downtown, swing by our offices at 130 Bloor Street West, and we'll chat about how we can help you become a more confident investor. What you have just seen is a sample of the service that our clients receive. We, of course, cover the FANGs, but our service is actually designed to find stocks that are trading at cheap or even sometimes incredibly cheap valuation levels, and spotting the right time to buy and, of course, to sell as well. And for the past 35 years, that we have been serving our clients, we notice that this is how the majority of our clients use our service to aid in investing. Anyway, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol and Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you not next week, but 2 weeks from now. Have a wonderful Christmas and season's greetings to all of you.